Is compound interest really the most effective way for ordinary people to achieve financial freedom? Welcome to the path to prosperity. I've never believed in what most people believe. And because of that, by the age of 23, I was able to achieve financial freedom through speculation. The most meaningless phrase in the world is this: let me show you what your life will look like in 40 years. Because by then, you won't even have the chance to regret it. 97% of people believe the best way to manage money is by leveraging compound interest. Why? Because someone named Albert Einstein once said, compound interest is the eighth wonder of the world. And Warren Buffett claimed he got rich slowly. These two statements have been repeated, often with hidden motives, until 97% of people came to believe in trading the present for the future. Financial salespeople hear this so often that even they start to believe it's true. They'll tell you, start saving now. The interest earned each day is added to your principal, which grows monthly and yearly. Your interest earns interest. By the time you're 60, you'll have millions, and maybe you'll be a rich old man like Buffett. Sounds great, doesn't it? But let's set aside how distorted that information has become. I just want to point out one thing: if I have to wait until I'm 60 to drive a Porsche, then what's the fun in that? I agree with the idea of trading the present for the future, but if it means trading today's money for future money, then I'm not interested. Long-term vision is important, but that's precisely why I choose to use today's money to gain today's money. Because if you don't have money today, how are you going to have any in the future? Recently, I came across a rather amusing story. One man advised his friend to quit smoking, saying, if you stop smoking, you could buy a Porsche in 20 years. But his friend calmly asked, do you smoke? The man replied proudly, I've never smoked a single cigarette. Then the friend smirked and said, so, where's your Porsche? You see, this is the problem. And if you're still watching at this point, I'll tell you how I truly understand and use compound interest to make real money. As for those financial institutions constantly emailing me to become their agent, they can stop. I'm not interested. I just want to speak plainly. No middlemen. If you support what I'm saying, hit like to show your encouragement. Let me be clear, this channel is for those who want to become entrepreneurs, investors, and the wealthy. If you don't want to miss valuable insights, subscribe and turn on the notification bell. First, let's re-examine our icon Warren Buffett. Did he really become wealthy through compound interest? The truth is, by the time he was 32, he had already amassed over $1 million. And that was decades ago. Do you really think he just worked a job and slowly compounded his savings into a fortune? When the average income was only $3,000, how could he possibly have turned that into $1 million? The answer is simple. He didn't rely on compound interest. He learned how to raise capital. At age 26, Buffett raised $100,000 from family and friends to invest. 6 years later, he had multiplied it tenfold. There are two key points here. Buffett's investment return rate was extraordinary. Though he advised others not to borrow, he used other people's money from the start. He always used financial leverage, but with extremely low or near zero risk. In some cases, the cost was effectively negative. He used other people's money to invest, and those very people had to pay him fees. At Buffett's company, you paid a management fee no matter what. If profitable, he also took a cut of the gains. On top of that, he owned several insurance companies. Money raised from them came at an even lower cost than free. In 2002, his company issued the first float-based securities in history. What Buffett was really playing wasn't compound interest. It was leverage. Everyone knows Bezos got rich through Amazon, Zuckerberg through Facebook. Billionaires built wealth through businesses. So why is Buffett the only one said to have gotten rich through investing? Many people believe that just by buying stocks, they're like Buffett. Then they look down on others who don't invest. I can only laugh. When a small investor buys stocks, it's just buying stocks. But when Buffett buys stocks, it's acquiring businesses. He gains full control of companies. Take Berkshire Hathaway. It was a textile company. Buffett bought it, initially planned to exit, but became the largest shareholder. He didn't know how to weave fabric, so he used it to acquire an insurance company, then transformed Berkshire into a financial conglomerate. Under his management, the stock value skyrocketed. Buffett holds a massive share. How could he not become rich? Looking at how he manages capital, he's more like an entrepreneur. All of his investment activities rest on one foundation: core capital. This is why Rich Dad, Poor Dad teaches become an entrepreneur first, then become an investor. Once you have steady cash flow and passive income, investing becomes effective. By then, your capital will already be large. Even with modest returns, you can earn a lot. Meanwhile, if you're salaried, even with great returns, you may not match my yearly income. I can invest in areas you can't. You can only buy stocks or funds. I can buy real estate or small companies. More importantly, we invest without pressure. Even if we lose money, our businesses still generate cash flow. But if you rely on a job and your investments fail, you could lose everything. Many people take their own lives for this reason. In the past, I tried to bridge the gap, but I was naive. Capital markets follow a brutal rule: the poor can become rich, but the rich rarely become poor. I've studied this deeply. Some say 99% of Buffett's wealth came after 60, but at 52, he already had $370 million. He was rich early on. After that, he simply used compound interest to amplify his wealth. To understand compound interest, you need three elements: principal, return rate, and time. Of the three, which is most important? It's still the principal. Return rate and time just multiply your base capital. But the risk is enormous. Each time you invest, you're putting in both principal and gains. Your math teacher might have missed this rule. If you earn 100%, $10,000 becomes $20,000. Lose 50% the next year, and it drops back to $10,000. To break even, you need another 100% gain. So I ask, is it easier to lose 50% or to double your money investments that double your capital? Are rare. But stocks that drop 50% are everywhere. That's reality. Most stocks move with the market. Tesla's drop wasn't just Elon Musk and Twitter. Compare Tesla's chart with the market index. They're similar. Same goes for Facebook and Amazon. When you buy a mutual fund, check its holdings. Most include these major stocks. And every so often, the market crashes. If you only know how to buy when prices rise, how will you invest? Buffett is exceptional because of his capital. He earned 22% returns and kept reinvesting. As for me, I make money faster through speculation. I only risk a small portion, often using leverage. My approach is different. I take profits quickly. He sticks to a long-term strategy. Most of my assets go into investments, aside from real estate. To me, real estate generates rental income and long-term returns. This is where I apply compound interest. If you understand me, you'll see I invest more steadily, more than just recycling principal and gains. In stocks, we only calculate net value. What does that mean? Imagine learning 10 English words daily. After 3 days, you've learned 30, but you forget a third. So you only retain 20. That's your net value. The more you learn, the more you forget. Same in stocks. Despite expert advice, most people lose money. If you've gambled, you'll get it. With small capital, you're not even qualified to play. Or if you are, you're just prey. In real estate, no experts. Actually, the government is the biggest expert. Even top Wall Street traders lose. And once you lose, losses compound too. If you keep reinvesting principal and gains, even a small loss hurts. Buffett couldn't afford even one major loss. One serious setback would wipe out decades of gains. That's why Buffett says rule number 1, never lose money. Rule number 2, never forget rule number 1. In 2020, Buffett lost tens of billions in airline stocks. He could afford it. But can you? Do you own assets that generate cash flow to cover losses? So why is compound interest said to be more powerful than a nuclear bomb? It's simple. Your math teacher probably taught you the formula. For example, you invest $100,000 in a stock. In the first year, you earn 10% or $10,000. If you keep investing just $100,000 each year and earn $10,000 annually, after 7 years, you'll have made $70,000. But if you understand compound interest and reinvest both principal and profits, the outcome changes drastically. In year one, $100,000 earns 10%, becoming $110,000. In year two, you invest the full $110,000 and earn another 10%. Now you have $121,000. The next year, you reinvest the whole amount again, and it keeps growing. By year 7, your money nearly doubles, from an initial $100,000 to almost $200,000. That's how you break even with a significant profit. That's why your math teacher engraved one truth into your mind. If you use simple interest, you'll earn $70,000. If you use compound interest, you'll earn $100,000. And they told you the longer compound interest works, the greater the profit. If you invest $10,000 today and apply compound interest, after 40 years, that amount could grow to $450,000. Even more importantly, if every year you contribute another $10,000 from your salary and continue reinvesting with compound interest, your profits will be more powerful than a nuclear bomb. This investment strategy is absolutely correct because it's based on a flawless mathematical model. But if it's that simple, and we've known about it since childhood, then why are there still so many people riding the bus instead of driving a supercar? The answer has already been mentioned. First, stable returns aren't always easy to achieve. Second, as Buffett says, compound interest takes time. And most importantly, you must first learn how to protect your health and extend your lifespan. Without time, what's the point of compound interest, right? If Buffett had died before 60, he wouldn't have earned 99% of his wealth. And if that had happened, who in the world would know his name? Now, I'm going to tell you a truth that might make you dislike business people and entrepreneurs. If you're a salaried employee, once you hit your 30s and you're still just a loyal staff member, it becomes very hard to move up further. Why? Because everything you accumulated before the age of 30 will likely plateau, unless you're a born genius or incredibly lucky. Otherwise, your path to promotion will hit a ceiling. This is a common reality. By that age, your position in the company is often fixed. Managers stay managers. Department heads remain department heads. The higher you climb, the fewer positions there are. When your role is capped, so is your salary. You might argue, that's not true. The company still gives annual raises. Sure, salaries go up on paper. In the past, hiring a fresh graduate might cost $1,000. Now it might take $2,000. But why is it because today's graduates are more talented? Because the quality of labor has drastically improved? No. It's because of inflation. Nominally, your income rises, but in reality, its value stays the same. You can verify this by going to the market and checking prices. Many governments also use this trick to raise the minimum wage to appease the public. They tell you, we've increased your pay, but they don't tell you that prices have risen too. On the surface, it feels like you're gaining something. In reality, you're not getting anything at all. So I'll say this directly. When you're young, have little capital, and can't control interest rates, stop dreaming about compound interest. It's irrelevant to you. I always tell people to focus on increasing their income while they're still young. But most people only worry about saving every penny. That's just a way to comfort themselves. They think saving alone will secure a stable and happy future. But in the end, they become part of the 97% whose savings will be wiped out by inflation and economic downturns in the next decade. This is called shearing the sheep. Buffett could play the compound interest game because he used other people's money as leverage. I invest in real estate using the same approach, but we don't accept the kind of investing where you put in $10,000 each year and wait 60 years to turn it into $1 million. Our goal is to use the initial capital as a foundation to expand assets, not to go small and hope for big returns. Can you see the difference? Here's my honest advice. Those who've been through this will understand. When you have nothing, no capital, why waste time chasing small bets for big wins? Why not focus on investing in yourself instead? Because you are the only asset you can fully control, and you are the most valuable investment. Do you know how much a truly talented person is worth? Exceptional talent is hard to find and fiercely sought after. I once asked a friend working in investment banking. He told me that when they find a great startup team, they have to travel to them and beg for the chance to invest. Founders don't even need to look for investors because funds are always lacking good projects. So what does the lack of good projects really mean? It means there's a lack of people capable of making those projects successful. That's why talent is the most critical factor. When you're young, if a good outfit can help you land a job, buy it without hesitation. If attending a networking event or business dinner could advance your career, you must go. Your life still has a long way to go. What I hate most is hearing people talk about saving or cutting expenses. People only cling to saving when they're afraid they can't earn more. That's why I want to show you another path. The path to prosperity. When the whole world is doing the same thing, you must choose a different road, one that even the biggest corporations overlook. Take the money you were planning to invest in financial products each year and use it as seed capital to start a business. Combine it with your own abilities to launch small projects that big companies won't bother with. Here's an idea. Just think it over. You could make a down payment to buy a Mercedes, not to show off, but to become a personal chauffeur for high-level managers of foreign firms or wealthy entrepreneurs. Because you bring your own car, your income won't just come from driving. You can include vehicle rental, gas, parking, and other service fees in your pricing. Just tell your client, pay me a fixed monthly fee and I'll take care of everything. After deducting your own salary, you can recover the car investment within a few years. I'm not making this up. A friend of mine did exactly this. Besides his main job, he used his car to earn extra income during free hours. After a few years, he made a 100% return. Then he hired more drivers, expanded his business, bought more cars, and eventually became a small business owner. Now he has real capital in hand. Of course, this is just one idea. There are many factors to consider. You don't have to follow this exact path. Some people flat out say they'd rather die than be a driver. Also, this job has income limits. I didn't do it myself, but if someone else can, that's already great. In my view, during the first 20 or even 30 years of life, interest rates and time matter far less than how much capital you have. In the first 20 years of investing, the returns from interest rates and compound effects are minimal. What really matters is how large your starting capital is. Without sufficient capital, it takes an awfully long time to produce meaningful profits. When you're young, don't get too caught up in financial investing. The most important asset is you. Only by increasing your own value will you never lack money in the future. That's what you should be focusing on right now. You must distinguish clearly between what is important and what is urgent. That is how you should act. That said, I'm not claiming compound interest isn't important. It absolutely is. If you can maintain steady profits, the effect of compounding will only grow stronger over time. There's a principle called the lotus pond effect on day 30. The lotus pond is only half covered, but on day 31, it's fully covered. That's exponential growth, the true power of compounding. This means during the first 20 years, time and interest rates don't make much of an impact. The most important factor is still your initial capital. Due to time constraints, I'll stop here. We offer free insights on how to become wealthy, start a business, invest, and achieve financial freedom. If you don't want to miss out, follow our channel, turn on notifications, and share this video. I sincerely wish everyone who supported this video will soon reach financial freedom. If even just 1 or 2 lines from this video helped your life in any way, I'll feel completely fulfilled.